Hello to all those who are watching. It's a pleasure to be here. I am Luis Garicano. I've been a professor of economics for a long part of my life in the University of Chicago and the London School of Economics. And now I am a, there is an echo. Something's not working. I apologize. It's I'll start again, just in case. There's no echo now. So, as I was saying, my name is Luis Garicano. I'm a professor of economics. Well, I've been a professor of economics at the University of Chicago and the London School of Economics, and now I'm a member of the European Parliament. I'm in charge of economic affairs for Renew Europe. And I'm going to be talking about what the European Economic and Monetary Union is doing against the COVID crisis. The crisis, it's a pandemic, and it's not the first time we confront a pandemic. I have some historical examples here to help you to think about how those other pandemics took place in the past. There was the Justinian plague from 5040 and 5041, where the Byzantine Empire didn't manage to conquer the Roman Empire because of that. The Black Death that brought the end of feudalism, the Italian plague, which had also momentous consequences. It was the Italian plague which led in Venice to the bankruptcy of several of the big banks and the creation of the first purely fiduciary currency. And more recently, the 1918-1920 so-called Spanish flu, which wasn't the Spanish flu, but that's how it has been traditionally called, which had a very big impact on per capita income. So we've seen big consequences in the past, and the question is, what will we see in the future? To give some context to the reaction of the European Union and to think of what will happen in the future, the first thing that I think is worth thinking about is what is a pandemic and how it is special. A pandemic is different than a war. We hear a lot, they talk about the war economy and how we are in a war economy, and there are some similarities, but there are also some important differences. First, the pandemic involves very little loss of both physical capital and human capital. Second, we're not seeing a drop in savings, but an increase in savings because of precautionary motives. People are scared. And third, we see increases in real wages in many pandemics. For example, in the Black Death, etc. The negatives is that in a war we keep the economy at full-blown gas. There is no effort to try to keep people at home. In fact, on the contrary, countries in a war economy are actually pushing to employ everybody as much as possible, to actually get as much production as the country can physically produce. And that's why we see, for example, this huge increase in participation by women in the United States. This is very different. This is really the unique thing of this pandemic and of a pandemic is that through quarantine, we have the exceptional situation that states ask people to stay at home. Unlike in all other situations where people are incentivized to produce and to consume and to do their lives, here we're asking people not to produce, not to consume, and to stay at home. In terms of the of the interest rate, what we see is usually kind of less. Obviously, there is less pressure in the economy. The interest rate tends to decrease rather than stay or go up. Why all this stay at home? Why all this effort to keep people at home? From an economics perspective, why not we leave people just take their own decisions? If they are afraid of the virus, they stay, and if not, they go. From an economics perspective, what is special about the virus is that it's a negative externality. Each person takes the economic-wide effects of us given and the effect of their behavior as given, and they don't internalize the fact that by going out, they are potentially creating effects on other people. So if you are left to your own devices, for example, if you're young and you're not particularly scared, you might not take enough precautions, the precautions that are necessary for the economy as a whole. There is a market failure, and that's why you need government intervention. In fact, even stronger, if we think that there is going to be immunity eventually and that everybody's going to be infected, people will have incentives to become ill early, so that they rather catch it now and do their lives than catch it later. So the externality could be large enough that you really need a joint collective action by everybody. And here's an example from a US demonstration. When tyranny becomes law, rebellion becomes a duty and reopen. So people are saying, we don't want the government in our way telling us what we need to do, when in fact, if there is such a big externality, there is one huge case for government intervention in a pandemic as in a war. The market, the individual reactions by people are not giving you the right incentives. Now, this externality, this need to freeze the economy, is going to create a race between supply and demand, where supply will drop and then demand will drop, as we see in a second. In a way, the crisis that you generate with this kind of crisis is much larger than in any other situation, because what happens is that the pandemic is like a never-ending earthquake. It's a situation where you are all the time suffering one after another, building collapse if it was an earthquake, as opposed to something that happens, it's done, we move on. So that creates uncertainty and liquidity risks that are particularly notable in the pandemic. So if you think about it from the supply-demand perspective, what you see in this graph is that there's first a supply shock where global supply chains were stopped in China, where quarantine forces people to stay at home in many places, so you have less supply. That's different from other crises, such as a recession, which was in the financial sector, from a war, where there is infrastructure, permanent destruction of infrastructure. Then the uncertainty and the fact that you need to avoid going out causes also a demand shock. The demand drops. Workers lose income, businesses lose customers because people are not going out. Households are staying at home, and you are seeing this big drop in demand. So you have a double whammy from the supply and the demand reinforcing each other. You can see here how households stop spending. This is credit card data from Spain, and what you see here is that indeed Spanish residents saw a huge decrease in their purchases, 60%. That's really unprecedented in a very short period of time. Foreign residents in Spain went even further. They had a basically 98% drop in expenditure, in credit card expenditure. Basically, that's tourism income disappearing. So you have this big shock that continues as workers lose incomes and as firms lack liquidity. You could actually see this reinforcing loop lead to a really very, very large crisis. This is particularly localized in certain sectors. The sectors where we see more of these problems happening are in red here, the hotel, the transport manufacturing in violet, the hotel restaurant sector, and also retail sector services. So countries that are more intensive in those sectors are going to see larger shocks. But the kind of shocks we've seen here are unprecedented. You never have seen shocks where 25, 30% of economic activity is affected, essentially shut down. Finally, and I'm not going to really address this issue here, but I want to just flag it. You see very, very large drops in flows of capital to emerging markets. Emerging markets are going to see the usual sudden stop, where basically look at this here, and here you see very, very large drops in capital. Here's almost a 100% reversal. The final economic impact of all of this is going to feed through governments. Governments, as we will see later, are going to do lots of things to try to cushion the shocks, and the consequence is going to be that in trying to replace the GDP lost, they absorb all the shock themselves, they insure the rest of the economy, and you see government debt growing by very, very large amounts in a very short time. We could see increases in 20, 30, 40 points of GDP, in debt to GDP ratios in many countries. Those are going from 100 to 120, 30 maybe in Spain, up to 180 maybe in Italy. Very, very large increases. The question is whether that's going to be sustainable, and we'll go back to that later. In the United Kingdom, the projections by the IMF, the recent projections by the IMF, which are probably very optimistic, talk about, for example, 10 points in the United Kingdom, 23 points of increase in debt to GDP ratio in the United States, in the euro area 12, in Spain 17%. Very, very large shocks. I'm not going to spend a lot of time on the dynamics on how this is going to move. We know very little. I just want to give you a framework to think about what are the main scenarios for the next months. The base case, which is that basically we managed to end the lockdowns, but we are basically remaining with social distancing for the next 6 to 12 months, and with small outbreaks, essentially see us with a big loss in Q1, similar or larger loss in Q2, depending on the country, and basically a recovery in Q3. This is the base case that now governments are using for their financial projections, for their debt projections, etc., and is the one that has underlined the decisions of the European Central Bank that we will discuss in a short time. There is a case that looks not unfeasible, and that, for example, the Center for Disease Control in the US has flagged as quite possible, which is that we see winter lockdowns. After this wave of lockdowns, we see another wave of lockdowns, which would mean Q1, Q2 are bad, Q3 we see a recovery, but then Q4 again we see a drop. This would be much more hurtful economically, because it would come to companies that are really running out of cash, running out of liquidity, and it would become a big problem also for the financial crisis. Here we have a big winter outbreak again, with lockdowns coming back in, let's say, October or November. And then there's a best case scenario. There was last few days, maybe 4 or 5 days ago, an article in the New York Times talking about the Oxford vaccine, where they're doing 6,000 people in the first round of vaccinations in a test trial before May, and then they're going to be doing, if this goes well, they say they're going to start vaccinations in September. This looks very optimistic, but if this happens, we don't have basically any problem in Q3. In fact, Q3 becomes a huge rebound. Everybody wants to finally go out and consume. And in this scenario, we basically are out of the woods by September, let's say. And finally, there's a bad one. And the bad one is that essentially we know that it's not impossible. The infection doesn't confer immunity. We basically have a situation which is recurring, not just one peak, but multiple peaks of infection that are rolling around the world, causing lockdowns, closures, and a very big slowdown of economic activity. Here, I mean, in this scenario, 50% drops in GDP in Q2, 10% drops in Q3. I mean, we're talking about very, very large overall drops in GDP for the entire year. 20% drops in GDP for certain countries wouldn't be at all expected overall in the year, 25% even. In this worst case scenario, which is not impossible, we would see probably the largest crisis the world economy has seen potentially ever. What are countries doing against this? Before we get into the European Monetary Union response, what are countries doing to fight against this crisis? Essentially, there are two curves that are interacting here, the health curve and the economics curve. Remember the most important graph of this crisis. This was the health crisis, the health curve that needs to be flattened. It's the infection curve with a big peak that basically puts all the emergency rooms out of commission. That basically means every country is facing a massive increase in cases. And in order to avoid this, we put in place the containment policies which were destined to flatten the curve. There is another counterpart with this, which is the economic curve that you see here, which is how deep is the recession. The recession without containment policies is potentially less deep, but And if you put the containment policies, that's the red corresponds to the red and the blue to the blue. In the blue case, where you're flattening this medical curve, you're actually forcing people to stop consumption from one day to the next. Those credit card curves that we saw were from the 15th to the 20th, the drop in expenditure is 60% of a magnitude really unprecedented, because you're basically asking everybody to stay at home. So basically, there seems on the face of it to be a trade-off between how much do they do on the health and how much do they do on the economics. Although probably over the longer run, if you're not doing these containment policies, you cannot really reopen the economy. The goal that you would have is to try to get a V-shaped recovery. The goal with government policies is to try to get the economy to survive this period of containment without permanent damage to the firms and families and entrepreneurs and governments of all of these countries. And the way you do that, given the damage you're suffering, is to try to target help to all of these sectors. Look, you're seeing the household sector that is being hurt and consumer spending is dropping. You see bankruptcies on the business side that have not just a solvency, but not just a liquidity, but a solvency problem. You see a problem with investment being reduced. You see a problem with labor layoffs, workers losing their income. And it's the labor layoffs which leads you to drops in consumer spending, which increases bankruptcies, increases labor layouts at the same time as the financial sector is in trouble and reduces credit. So all of those things you want to reduce. So there are basically three aims that you try to accomplish with all of these measures. The first aim is to protect workers and incomes. The idea here is you're going to make sure that nobody who's forced to stay at home is losing their income just because they have to stay at home. You're trying to insure everybody against the shock that they are suffering from this crisis. The second is make sure that firms can survive the shock. There are very, very few firms around that have more than a few weeks, a month of cash around, even big firms at hand. And you need to, once you cut the flow of income, there are fixed expenses like rentals, like paying the suppliers, like paying the mortgages, like paying the loans that they have received. All of those things can lead them to bankruptcy. So you need to ease borrowing terms, temporarily waive tax and payroll payments, etc. And thirdly, you need to support the financial system. Eventually, it's the collapse of the financial system which causes a system-wide crisis. The financial system is the lifeblood that links all of these businesses and individuals. And if banks collapse, then everything else is very directly affected. So first, how do you protect workers and incomes? We have seen very, very large increases in unemployment. For example, in the US, we've seen 26.5 million claims already by April 2020. This very, very long month. Imagine like what has happened in this short period. Takes usually in any recession would take months and years, and you will reach these levels. The most affected jobs by the coronavirus have been the construction, hospitality, arts and leisure sectors. Those are where we have seen most, not just in the US, but everywhere, as we will see. The shock hasn't affected in terms of the impact on the job market, everybody the same way, because there are different countries have different amounts of jobs that are directly affected by people staying at home. First, because in some countries, people can do more jobs at home than in others. If there is more of a service sector relating to banks, insurance, etc., you can do those jobs at home. If there is more retail, transport, hospitality, then those jobs are directly affected. And thirdly, the fiscal stimulus. Depending on how much fiscal stimulus has been put, you have different impacts on activity. Somewhere like Greece or like Spain has not, and that has a relatively large share of jobs in retail, hospitality, etc., plus has a lot of jobs that cannot be done at home, and a relatively small stimulus are very likely to be very strongly hit. Which jobs? As I was saying, in the US case, there are jobs that are at low risk of being lost. Essential occupations like health, no impact. Occupations where you can work from home, no impact. Certain other salaried occupations that are essential, low impact. And then very high risk at other occupations like sales, like hospitality, like retail, like transport. Those are occupations that essentially either come to standstill or disappear. This different impact in different types of jobs is actually increasing inequality, because the jobs that can be done from home tend to be jobs that have these information jobs that have more value added. So what we see, for example, here is in the UK data, and this is American data, is that jobs that are lost in the less than 10,000 categories, almost 20% of the jobs. In the more than 10,000, 70,000 categories is less than 5% of the jobs. Similarly, in the US, jobs that can be done from home are more likely to be in the very high percentile. Jobs that can not be done from home are more likely to be in the low wage percentiles. So how do countries react? I have here a list of 4 possible policies that we see countries putting together. There is first an expansion of paid sick leave. This makes a lot of sense because you don't want workers to continue working just because they feel that they cannot take time off. Second, you see an expansion in unemployment insurance. This is the main tool in the US, where they basically expand radically eligibility and replacement rates so that everybody can be reached by unemployment insurance. Third, you see wage subsidies. In certain countries, you fund firms to be able to pay workers. And fourth, and that's the European way, Kurzarbait, the objective of short-time work schemes, which is to basically maintain the link between the workers and their firms, make sure that they're still employed while not working. So you can be working at home, working part-time, working less hours, and continue receiving your wage. The idea of the short-term scheme has been very, very general in Germany. Those are the ones that invented this idea of the Kurzarbeit. And the idea in general is, let's not fire workers. Let's reduce layoffs so that we can maintain these valuable relationships and to make sure that workers don't have to reach the stage of unemployment, which is also psychologically very damaging apart from economically. So you reduce the social security contributions by employers to ensure they want to keep them employed. You pay the salaries or a big part of the salaries of workers, and that way you ensure everybody's attached. On the negative side, these Kurzarbeit schemes inefficiently reduce the reallocation of labor to more productive sectors, and as a result, could be more conducive to stagnation and not to dynamism and rebuilding new sectors. But I think in a shock like this, where it's a temporary shock, you really have the conditions to put these short-term work schemes in motion. And we'll see how the European Union has gone in this direction. Is this the moment for helicopter money? One measure that we've seen in many places, from Singapore to Hong Kong to the United States, is since social safety net is not really designed for a moment like this, just send money to everybody without conditions and without asking questions and without paperwork, just to facilitate that everybody can reach this aid. As you see here in the United States, this $1,200 check that everybody is receiving is actually in every single case signed by Donald Trump. You can see here his signature. The second type of measures that European governments and worldwide governments are taking aim to protect firms. The idea here is firms are basically seeing their business disappear. Look what happened between February and March, the very large drops in stock markets, to some extent recovered over the last month, surprisingly, to be honest, but very, very large drops, 25% decreases in market capitalization, particularly in sectors like energy, transportation, etc. Most sectors, only very, very few sectors have been left out of this crisis, of this drop in stock market values, like healthcare, telecoms, obviously, all the internet service sectors, and a big increase also in volatility. As I was saying, the retail and travel sectors have been the one that have seen bigger drops. We see the restaurant bookings basically collapsing in every country to zero, as people have to stay at home, and also global flight traffic collapsing. There has been very recently a survey by Mayan Bertrand and co-authors in the United States asking firms what's their view of their own situation. 43% of businesses declare themselves to be temporarily closed. Median business has less than 1 month at hand, and they are financially very constrained. They are not sure. They're very confused about how long this is going to last. They want to seek funding from the US government. It's difficult and it's bureaucratic, and they're struggling with that. The main effort that we have seen undertaken by the wide range of governments in Europe has been loans and guarantees. Basically, what we have seen is that governments have facilitated liquidity to all firms in the economy to be able to pay their bills. The aim has been that you don't suddenly get out of customers and then you have to go bankrupt because you can't pay your bills. You get guarantees and loans to facilitate that you can get out of the hole or at least postpone the pain. Now, mind you, this helps with liquidity but doesn't help with solvency. But this is the main scheme that has been put in place. More helping with solvency, governments have either postponed, eliminated some tax duties, some tax obligations, social security contributions as well. Most governments have eliminated or facilitated the payment of the social security contribution. What we see in almost every country is tax deferrals and social security deferrals in most places. You also see in some places actual reductions of tax relief or reductions in social security contributions. The final set of measures that we see have to do with protecting the financial system. The idea here is let's avoid what is a crisis in the consumer and firm sector to drag it down our banks and get to the point where those banks are actually also insolvent and stop providing credit to the economy. How has this been done? This is done in every country. We've seen measures that undermine or delay the implementation of Basel III, delay the implementation of IFRS 9, make the coverage, the liquidity, the capital ratios, etc., much more lenient, so that basically you don't have to be worried if you're a bank about loan repayments immediately. Eliminated the capital buffers, exactly the same type of measure. This has happened in the European Banking Union. The SSM has done this and has released a very massive amount of capital relief and lending. We've seen, as I was telling you, prudential measures basically in every single zone of the developed world, Japan, United Kingdom, United States. All of these things have been put in place. So all that to serve you as background to what is the main purpose of this discussion, which is to actually talk about how is the economic and monetary union reacting against this crisis. What are the pros? What are the cons? What are the limitations? The aim of the European and Monetary Union, Economic and Monetary Union, is very similar to the aims of the different governments that we have discussed. The aim is to protect banks and the financial system, firms and families from an aggregate collapse that could have repercussions in that race between demand and supply that I was showing you before. The first actor to act, and the most important, has been the European Central Bank. The European Central Bank has a very large and very large firepower and a very independent way to act. It is the only institution in Europe that is really fully federalized, that has one single head, that acts not intergovernmental, no countries voting, really a single institution, and has been part of the whatever it takes actions of the Bank of England, the Federal Reserve, and all the other banks, the Bank of Japan as well. The idea is, if we want to avoid a financial crisis, if nobody's able to pay their debts in the economy, if nobody's getting any wages, where is the liquidity coming from? The idea is the central banks realize we are the only game in town. The Fed has taken absolutely unprecedented measures. It's buying everything, not just money market funds and corporate funds and bonds from the government, but also it's buying like municipal bonds and bonds from the cities. It's buying debt from the states. It's buying student loans. It's buying everything. The Bank of England has gone much further than any other institution, because the Bank of England is the only institution that has actually told the Treasury that it will directly fund the Treasury efforts directly. So you don't have to go into the market and raise some money in a bond or something. If you're the government of the UK, you ask the Bank of England to write you a check. End of the story. And the check gets written by those who make the money. So there's no limit to the checks they can write. In the EU, what we have said is a new huge program, which is the Pandemic Emergency Purchase Program, that was for 750 billion, and the public sector public program for another 120, for a record total of 870 billion program. This is totally unprecedented compared to the purchases that seemed so big during the financial crisis. These are really, really tiny by comparison. The European Central Bank is coming in later. Look at this huge $1 trillion purchases by the US Federal Reserve, and a huge expansion of the balance sheet from one day to the next. In the EU, we couldn't do what the Bank of England did. It's impossible to just go and write a check to the member governments, and it's just as good. There is an article in the treaty, Article 123 of the Treaty of the European Union, which says that any credit facility by the European Central Bank to any government is forbidden. This is as straight as that. How is it interpreted by the European Central Bank? Basically, the European Central Bank considers itself limited to how much of any issuance it can buy. So if you issue debt as the government of Germany or Italy, the European Central Bank commits itself not to buy more than 33% of that debt, and to buy debt in proportions to the size of the countries. I'll explain those two restrictions right now. The first restriction is the 33% position limit. It basically says that of any particular issuance, you issue today debt to be repaid in 2050, 30-year debt. The European Central Bank commits to not buying more than 1/3 of the outstanding of that debt. The reason they do this is because if a country were to go insolvent and the European Central Bank was very large, it was the main creditor, you would go to a position where the European Central Bank would have to negotiate with that particular government on the repayment, on the default, etc., etc. And that would be an eminently political job, and they want to avoid that. If you look at the table, you see that the debt that they hold from some countries is a little bit higher. That's because this limit only applies to 1 to 30-year maturity. If you have a maturity which is a bit longer, you can get a little bit more. The second restraint the European Central Bank puts on itself is the capital key guidance. Essentially, what the European Central Bank says is, I will hold debt of the different countries in the same proportions as they hold equity in the European Central Bank. You use the capital key of the European Central Bank, which says almost 26% of German capital, a little bit more, 20% of French, 16% of Italy, and you try to hold similar proportions of debt of those countries. In fact, it's not exactly the same. You see that for Italy, they hold 24%, almost 25 actually, and it's only 26% the weight of Italy in the central bank's capital. But you try to be consistent. These two restraints constrain what the European Central Bank can do and limit how much they can support a particular country. For this reason, they've put a particular asset program in place, which is this Pandemic Emergency Purchase Program, which is 870 billion worth of purchases, including the PEP, the Pandemic Emergency Purchase Program that is here, and the Public Sector Purchase Program. You can see here how much it is. It is 750 billion plus 120, 870, and how much is being used. They're basically using 25 billion on average purchases from the pandemic emergency purchase program. That's a lot. 6 billion from the public sector. That's 31 billion roughly a week, which means that the program probably will run out by mid to late October 2020 in total. What is the goal of this program? The goal is to avoid a self-fulfilling spiral. What is unusual about the European Monetary and Fiscal Union is that you have countries that are not fully necessarily committed to stay in the euro. They are committed, they say they're committed, but they are sovereign. They could always abandon. And that raises questions in the market. Look at what happened to Greece in 2011. When funding became expensive for Greece, investors start to worry about whether Greece debt is going to be sustainable. The question is, will Greece be able to repay, or might Greece choose to exit? As you start wondering this, you're wondering, hey, I'm just getting 2, 3, or 4 points more of interest for the debt that might be worth nothing if this country exits. And so you ask for a bigger debt premium, which means that Greece is even more insolvent because with higher interest rate, it's less likely to be able to pay. And as a result, it is more likely to exit, and you get this vicious circle. The aim of this program, the ECB, is to eliminate this risk. The second line of defense to eliminate this risk has been the Eurogroup agreement. The Eurogroup is formed by the member states of the Economic and Monetary Union that are together aiming to fight against this potential liquidity crisis. Look, Europe is a very complicated animal. I told you the European Central Bank was the only one that was consistent and acting as one. In fiscal policies, there's 19 members in the European Monetary Union and the Euro out of 27. In fiscal policy, the 27 have their own separate fiscal policy. So you have 19 countries which have a centralized monetary policy, but you have fiscal policies which are coordinated only loosely. And you have, and I go back to this Greece case that I was telling you before, this renomination risk. You have the risk never really eliminated that you could have large shifts in risk perception suddenly as somebody starts wondering if country X or Y is going to be able to sustain its commitment to the euro. That also creates these sudden spikes in risk and these flights of safety to safety where people suddenly start to worry and abandon debt of one particular country, causing the interest rates to hyper skyrocket. Fiscal policy is loosely coordinated, I told you, and it's very interesting to know that it's only coordinated on the downside. It's easy to coordinate restricted fiscal policy. It's very hard to coordinate people to expand their fiscal policy, to want to do a fiscal policy that is more expansive. You can ask people to spend less, but you cannot ask people to spend more. That gives an asymmetric bias to the fiscal policy that is very complicated. Moreover, you don't have one actor. Look at the US. You have the US president as an executive power, and you have the Secretary of the Treasury as Minister of Finance. The corresponding actor to the US president would be 29 people, probably. The President of the European Commission, the President of the European Council, and the 27 members of the Council of Heads of States and Government. The equivalent of the US Secretary of the Treasury would be the European Commissioner for Economy, the President of the Eurogroup, the Managing Director of the EFSM, the Rescue Fund for Europe, and the Council of Ministers, again with 27. So here there are 30 actors, here there are 29, but in the US there is only one. We have been trying to deepen the Economic and Monetary Union. There's many projects in Parliament, from the completion of the banking union, by putting a deposit insurance, to reforming the EFSM, to trying to get qualified majority voting in tax matters, to getting some sort of European common debt. All of these things are slowly advancing. At the moment, all this is only in the drawing board. And the truth is we have an uncoordinated, independent fiscal policy. So the Eurogroup has taken some time to act, but it has acted relatively fast. has gotten 3 lines of defense. They're all in form of liquidity. They're all loans. None of them is actually a grant. They lend money to the countries. The first line is the EIB, the European Investment Bank, which ensures liquidity to firms. The second line is SURE, which protects workers and incomes. And the third line is the EFSM, which protects the states and ensures that states have money to finance themselves through all this crisis. The European Investment Bank was 25 billion, or was agreed, that gets leveraged up. The European Investment Bank puts guarantees and expects other national guarantee schemes, commercial banks, etc., to come through with money, private money or other money that complements this guarantee, so that 25 billion gets transformed into 200 billion, more or less. This is not a very large amount of money for something as large as the European Union. Just Germany has put 550 billion in what they call their protective shield for companies. The second idea of the Eurogroup is a Kurzarbait for Europe. In fact, this is an idea from the Commission, which the Commission borrows in the markets and lends at the same rates as it gets to member states. Member states must spend these borrowed funds on employment schemes that keep people in jobs rather than letting them fall into unemployment. It's the Kurzarbait that we were talking about before. Remember, we were talking about European Union schemes that are preferred, like in Germany, etc., where workers continue being attached to the job, are preferred in Europe to letting people fall into unemployment. The main precedent for this has been the EFSM. It was the rescue fund that Europe put together for Portugal, Greece, and Ireland. It was basically based on an article in the treaty that allows the Council, on a proposal from the Commission, to provide financial assistance to member states. The Commission borrows in the markets and lends it to member states. Why are member states benefited? Because maybe they don't really have the ability to borrow the markets, or their ability is at higher interest rates. And that means that they benefit from borrowing together. How do we finance this program? How do we finance the SURE program? This was the EFSM, which I said was the inspiring idea. In thinking about how we finance the program, we have to understand that the access to funds of the European Commission is limited. The European Union has limits on the budget. It has 2 limits that have been holding its ability to borrow and lend in this crisis. The first is that the states, when they agree on a multiannual financial framework, they put a limit on how much they can pay. And this is 1.16%, 1% of the gross national income. Think of it as the gross domestic of the GDP of the countries, okay? 1%. Second limit, if there is something extraordinary, it can go up by another 0.07 to 1.23% of GNI. That means that if you're going to borrow money, if you're going to use more money, it has to fall under these limits. That's complicated. The possibility to go beyond that is only if you have a voluntary guarantee. Of course, a country can voluntarily offer to guarantee whatever they want. And this is what the European Commission has tried. They tried joint pro rata guarantee, that didn't work. And what they tried is, okay, we ask countries to provide voluntary guarantees for this $100 billion program. So look how it works. This is the European Union budget, 154 billion. It has to all fall under 123 billion limit, a 123% limit. This is the EFSM, 47 billion. And this is the limit. It's kind of running out. There's only 9 billion under the limit. That's not enough for anything. So the Commission says, okay, the SURE program, this 100 billion, we're going to ask the countries to give a pro rata guarantee. And only they vote it, they approve it, and only when all the countries give their guarantee, the program starts. So it requires unanimity, essentially, because all the countries must have agreed. And this is the way the SURE program is financed, and it's going to be oriented, as we said, to helping countries with their indebtedness, to pay for their unemployment short work schemes. The third mechanism is the European Stability Mechanism. Just to give you a bit of history, this was created to help European area, Euro area countries that were in distress, and it was meant to provide loans that would be in exchange of undertaking reforms. Countries vote according to their economic power, and there is a capital that is paid in. The ESM has 80 billion paid in, and it has a promise from the countries to commit more capital, another 624 billion, so that add to the total subscribed capital of 704 billion. So the subscribed capital hasn't been disbursed. It's like, okay, I say, yes, you can count on another X billions for my country, but you don't have it now, it's just a promise. The ESM has then a maximum lending capacity of 500 billion. It had used some for those programs in the rescue, so it has 410 billion ready. The countries request support. There's a debt sustainability analysis. ESM is released. What is the problem of the ESM? The problem of the ESM is stigma. The problem of the ESM is that for many countries, the possibility of asking from the ESM for a loan is politically very, very complicated, because it's going to look like they failed and they're asking Europe to come to its rescue. Because the ESM comes with a troika, with a man in black, comes with an adjustment plan, you have to commit to doing lots of reforms. That's going to be politically very humiliating and very difficult for different countries. So basically, what Italy, Spain, and others have asked is, okay, if we're going to use the ESM, it has to be without conditions. Without conditionality, let's make an ESM that doesn't have conditions. The Eurogroup said, yes, fine. And they launched the pandemic crisis support line, which has 240 billion. And the idea is, we're not going to have macro conditionality, we're not going to have money in black, we're not going to have troika. You just need to promise that you will use the money to finance healthcare, prevention, cure costs of the illness, direct and indirect. This seems to fulfill the conditions that countries would want. But the truth is neither Italy nor Spain have proven satisfied with this program. They basically say, it still has stigma, we don't want to use it. This is a bit surprising. They've been fighting a lot to get these programs. They've been fighting a lot to get this support, and now they say they don't want to use it. Why? Partly it's a negotiation strategy, probably. They're trying to burn their boats. They're trying to say, burn the boats is what we refer to Magallanes did when he was conquering Mexico. He told their soldiers, sorry, there's no return back to Spain because we're burning our boats. So this is the same idea. These countries say, we are not going to use this. We're committing to not use it in order to increase the bargaining in the next program that is the most important one, as I tell you. Could you take some water? Please. First leg was the ECB. The second leg of what the European Union has done has been these three programs from the ESM, the EIB, and the short, three programs approved by the Eurogroup. And the third line is financing the reconstruction. And this is the idea of the Coronabonds. Here, some countries have been arguing already for months, more or less, that if Europe doesn't have such a big hit, we should come out of this hit together. We shouldn't have a big pile of debt upon some countries. The bad luck of this crisis is that it has hit particularly badly countries that have particularly high debt loads, Italy and Spain. And some of you might be thinking, well, Italy has a lot of debt because it didn't do things well. It's true, it didn't do maybe things well in a very distant past, but the truth is, since the euro exists, Italy has been well behaved, if you want. In 29 out of the last 30 years, it has run a primary surplus. It has been spending less than its revenues from taxes. So it's actually been running a quite sensible policy. But the truth is, it has a very, very high debt. And it happens that Italy is going to have a bigger hit because it has tourism, a bigger hit because it has an older population, and a bigger hit because the illness was more severe there. So if we let Italy carry the load on its own of this crisis, probably Italy is not going to grow again. So the idea is, let's do it together. Northern countries in general object very strongly to debt mutualization. They say, we don't like that because we don't have common government. They say it's like sharing a credit card with your friends. Everybody has the same credit card. We don't have a way to make decisions. The one who spends more is going to make the others incur a higher cost. The fear is that those who are more responsible will benefit from their responsibility. So there is solidarity, acting together, and there is moral hazard on the other hand. My answer to that would be that it's not really just about bailout, about solidarity. It's about the common interest of all the member states. You don't want to have a member state that falls behind, even if you're Dutch or you're German. You don't want Italy just for your own interest. The truth of the matter is the countries that have most benefits from the single market are the northern countries. The ones who benefit most from the dynamism of the European economy are those countries. And if Italy was to go bankrupt, if Italy was to have a problem repaying, they will be the ones probably suffering most. Now, the problem with joint borrowing in Europe is that the treaties have some restrictions that we have to take into account. First, Article 310 says that the EU must have a balanced budget. And Article 125 says that there cannot be a bailout. Both of them have nuances. 311 says the union shall provide itself with the money for its objectives. And on the no bailout clause, it's clear that you need to do what you need to do for the joint execution of a project. In Article 310, it does say the union's budget shall be in accordance with the European Parliament and Council decision and shall be in balance. But it's also true that it has to give the means to pursue the union's aims. 125 indeed does say that the union should not assume commitments for the debt of regions, governments, local institutions, etc. So how can we do a common debt vehicle for Europe under those two restrictions? The first proposal is the French proposal. The French proposal is similar to what was done initially with the EFSM, which is to create a special purpose vehicle. What is a special purpose vehicle? It's like creating a mini bank. You create a mini bank in Luxembourg, for example. You give it the ability to borrow on the market and to lend. It gets guarantees by the member states. It borrows in the market very cheaply and it lends to other member states. It's a private company and member states kind of lend and borrow through it. It can be paid by the member states in certain proportions according to the GDP, the GNI in this case, and then it spends on the most affected countries. That's the French proposal. It has some issues. I don't think it's a bad proposal, but it doesn't have the European Union acting together. It's a way for countries to borrow more cheaply, to do certain projects more cheaply, but it doesn't really have European Parliament, European Commission, European expenditure on European projects. Guy Verhofstadt and me have proposed something somewhat more ambitious. The idea is that the Commission should borrow in a form of perpetual debt or very long-dated debt that has very relatively small payments per year with money that would be spent as in the European Union budget and that would finance by own resources. The political trick here is we are telling the member states, you don't have to commit a single euro more to the European Union. The way we're going to do it is we're going to have European fees, European taxes on certain activities that are getting under tax currently that will flow directly to European coffers to pay for those interests. The legal basis could be one of two. Article 122.1 that says that in spirit of solidarity, you can take measures according to the economic situation. And Article 352, which basically is a carte blanche with unanimity, allows the member states to do anything that is not in the treaties. This permanent debt, what does it mean? What basically happens is you issue the debt and you commit, you don't have a fixed date by which time you have to repay it. You just can repay it, rescue it whenever you want. The first UK consoles were used, UK consoles have been issued often by the United Kingdom. The first were used in 1752 by UK government with a 3.5% coupon. They have used them to pay for the abolishment of slavery. They've used them to pay for World War I, for the Napoleonic War. Anything that is a big one-off expense has been financed this way. There was a decision by the UK government in 1415 to repay these 1927 and older consoles that were by then very small relative to the big size of the UK economy. There are more recent precedents for long-dated debt. Israel just did a 100-year bond at 4.5% coupon. Austria has done a 3.5 billion 100-year bond as well. And the European Stability Mechanism has had 40 years bonds with 1.85% coupon. The EU right now is financed mostly through tariffs and VAT-based contributions, and the member states directly. What we propose is to pay the interest of these bonds. So you issue a 1 trillion bond. We say, to be very conservative, you pay 2.5% per year interest, 25 billion per year. And you pay that interest from new resources that flow directly to the European Union. And these are resources that the European Commission has proposed an estimate. We're not doing the estimate that suits us. These are estimates from the Court of Auditors of the European Union and from the European Commission. So you expand, you have a plastic contribution, you have a digitax, you have potentially an harmonization of corporate tax bases, you have an expansion of the emission trading schemes that gives you enough money to pay for the money that you would need in interest. If we say interest 25 billion, you don't even need the CCTV in order to pay all of these interest. For example, if you think it's going to cost you 2.5% and you have 25 billion to pay, you can pay around a trillion, in debt. Over the next days and months, the European Parliament, the Commission, the Council will have to struggle to finance this rescue and recovery plan. We will have to try to get Europe to recover without too much debt overhang. And I would hope that we manage to do that together. We will be working on that over this time. Thanks very much, and I will now take your questions. I don't know if the questions will appear here or will appear in my chat, or I have them in my phone. Albert O'Hill, should the EU face the crisis together by using a common budget and getting into debt, all the countries at the same time with common fiscal policy? Yes, the European Union, you don't need all fiscal policies to be together exactly the same, but you do need some common debt. The reason is that the European Union has the ability to borrow and lend together and need to save assets in a very effective way together and avoid the individual member states being under a huge debt overhang. Debt overhang is a situation that happens when one particular country faces an overwhelming amount of debt that doesn't allow it to access the markets. You could think of a shop that the shop owner has one debt, has a mortgage, etc. You don't want to invest in that shop because you think if it goes badly, everybody's going to get paid before me. Rayman, can we expect a correlative increase in Italy and Spain? I think the main risk of a financial crisis has been put away by the determined action of the ECB, also the Federal Reserve and the Bank of England. I don't think we're going to see a financial crisis unless this health crisis gets massively worse than it's looking right now. Antonio Subiron, bad time in UK for leaving right now from the EU, but how will Brexit affect us in the fight against COVID-19? Brexit right now, it's in the freezer. we have a transitional agreement that lasts until the end of this year. Right now, everything between Europe and the EU is in the UK is exactly as it was before the crisis. In that sense, there is no real difference right now. Brexit is something that will come as an added challenge at the end of this year. I hope the European Union, the United Kingdom postpone, get a bit of a longer transitional period, given how complicated this year is going to be. Miguel Fournier Perez. Should there be structural EU reforms following the pandemic? Do you see appetite for them from member states? Many countries need serious structural reforms. Many countries face sustainability issues, growth issues, pension issues. We need European Union countries to face up to the need to expand growth and to the demographic crisis they're facing. So I would hope so. And I would hope that this crisis will be a sport, not just for new spending in green and digital revolutions, but also for the European Union to take the decisions that it needs to be stronger, and for the European member states to take those decisions as well. I think those are the questions that I have, or the ones that I see right now. Thanks very much. And it's very nice that you're here, and I hope that you enjoy it. They're repeating that I forgot the question from Enrique Gracia. We're second country by death ratio in the world. Spain is the second country by death ratio in the world. Not the first. We start with 98% debt. Doesn't make sense to ask for ECM agree to a structural reform. He's asking, structural reform should be in our interest somehow. Yes, the problem is macro conditionality might not give you the kind of leeway and the kind of reform that you need later. Macro conditionality will also involve some austerity. They might involve a path of debt and of deficit that is not the one that you need to recover. So yes, we need some reforms, and I think we need some help in getting those reforms from outside, but it's not the ESM, the vehicle, I think, to do it, both political and economic reasons. Thanks very much to all. It's been my pleasure to have you here, and I'll see you around. I hope you enjoyed it.